Crude oil is known as the Wild West of the markets. Why? Because crude oil exhibits huge volatilities, consistent volumes, and it's worth trillions of dollars in market value. Add it all up. Volatility plus liquidity plus market cap equals opportunity. There are countless opportunities available to anyone who has the guts and the smarts to trade crude oil. In the next few minutes, you'll learn how to trade oil like a pro.
Now, before you dive into the markets, you must pick a way to trade oil. There are two primary crude oil products, North Sea Brent, or Brent, and West Texas Intermediate, or WTI. Now, both of these are viewed as global benchmarks for the trade of high-quality, light-sweet crude oil, such as U.S. oil, UK oil, WTI, or Brent CFDs are great options. If you're in the U.S., CFD trading is not permitted. To trade crude oil, you will have to consider WTI futures offered by the CME Globex electronic market or those found on the Intercontinental Exchange. Now check out a free demo over at switchmarkets.com to explore their robust lineup of crude oil products. No matter which version of the oil you trade, it's vital that you understand two strategies, fundamental and price action. Let's explore how each can help you make money. All right, let's talk fundamentals. A fundamental market driver is a factor that moves an asset's price. For oil, the important fundamentals are the ones that impact supply and demand. Now, the relationship between supply and demand can be complicated. Let's keep it simple. When demand outweighs supply, oil's price goes up. When there is more supply than demand, oil's price goes down. Easy, huh? Now, crude oil fundamentals are anything that can impact the supply and demand dynamic. Some are planned, and some come as a complete surprise. Now, professional traders are aware of each type of fundamental, and they trade them accordingly. Now, every Wednesday, holidays permitting, the U.S. Energy Information Administration, the EIA, releases its weekly crude oil supplies report. This brings immediate volatility to oil pricing. Many traders look to get the EIA report nailed. They look for clues on whether to go long or short each and every Wednesday. Now, if supplies come in beneath expectations, they look to bid the market. If supply outpaces expectations, they look to sell the market. Now, these are incredibly risky strategies, and to sort of illustrate this risk, here's a 1-second chart of CME full-size WTI futures during a typical EIA release. Now, remember, each tick is worth $10. Take a look at how fortunes can really change hands in just a matter of seconds. This is run at real time. Take a peek. Now, this is around the weekly EIA report. You can see that we're coming up on that 10:30 Eastern Wednesday, and you'll notice right there, there's a huge volatility, an extreme amount of volume hitting the market. And for fundamental traders that attempt to trade this, it is very risky. You have to have deep pockets, and you have to be able to execute your strategy and give these trades the proper room to work. As you can see, we just went from beneath 74 up to 74.32 at $10 a tick. That's $300 rotation in just a few seconds. So if you're going to trade fundamentals in the EIA weekly report, have deep pockets. Perhaps the single most important fundamental trading strategy for oil is seasonality. Oil prices normally trend during specific times of the year. These trends often coincide with the summer and winter seasons in the Northern Hemisphere. The seasonality of crude oil is as follows. Prices typically rise from mid-March to mid-June and fall from mid-August to mid-November. Why? The demand for refined fuels. Remember, crude oil is used to make gasoline and diesel. As demand for these refinements grow, oil prices rise. As demand for refinements shrink, oil prices fall. Demand is the highest in the summer months of the Northern Hemisphere and the lowest during the winter months. Here's a very basic fundamental trading strategy. This is seasonality. As simple as it gets. You're going to look to sell crude oil every October. You're going to look to buy crude oil every May, and your holding periods anywhere from 3 to 6 months, depending on what your profit target and your aspirations are. So you can see back here in 2008, you catch a big bearish move, and that makes up for a lot of these losses when we go very, very choppy here from 2011 to 2014. So once again, you catch another big bearish move there, really back in 2014, and we get choppy again. You catch a bottom right there in May of 17. Nice little profit right there in May of 18 as well. And then you catch the really the mother of all seasonal trades, and that was the bid right after COVID, May after COVID. And that trend really went huge for about 3 years. So recently, 2023 May buy was a pretty good little payoff, buying about 60 and getting out at 90. So seasonal trading, the goal is to catch macro trends. It's a fundamental strategy. You can look to sell every October and buy every May. And really since 2008, you're in the money just because you're catching these huge, monstrous trends when they develop. The second strategy for trading crude oil is pure price action. Price action trading is the art of using price and nothing else to trade a market. We cover price action strategies regularly here. Be sure to subscribe to Forex Signals TV to never miss a price action update. Now, due to its volatility, crude oil is an ideal candidate for price action trading. Here are two ways that pros use price action to trade oil: range-bound and trend-following price action strategies. If you're going to use either strategy like a pro, then it's best to know when to trade crude oil. Savvy traders know that oil moves the most during the approximate New York session. This occurs between 9 a.m. Eastern and 2:30 p.m. Eastern, Monday through Friday. These periods feature maximum liquidity, volatility, and participation. It's a price action trader's dream. Here's an example of a range-bound price action strategy that many professional crude oil traders trade every single day in the crude oil markets. This is an old strategy, but a lot of folks still trade it. Now, the first thing we're going to do is we're going to look at our time period between 9 a.m. Eastern and 2:30 p.m. Eastern. We're going to look at that first 60 minutes of trade. Now, we're going to see the high there and the low here. That's going to give us our trading range for the rest of that U.S. session. The top of this high is going to be a signal to sell the market, and the bottom of this low right here is going to be a signal to buy the market. Now we're playing a range, meaning our profit target is going to be somewhere in the middle of this first 60-minute range. Now you'll notice our stop losses are on the outside of the range. Right here we've got a 10-tick stop loss, a 20-tick, and a 30-tick, and as you can see right here, the sells came into play. We were able to sell this high at about 10:30 a.m. Eastern, and we were able to sell it again at 11 a.m. Eastern, and both those trades were relatively profitable given a very, very tight stop loss location. So both of those hit the pay dirt, and really no bias came into play throughout the entire session. We had one losing trade near the end of the session, but the beauty of range trading price action strategies is you're only wrong once. So right there you lost, but you have two winners right here. As long as your risk versus rewards balanced, you can do very well just using that basic price action strategy for a range bound market. Okay, here's a price action trading strategy designed to get in on trends using price action alone. Many pro traders execute trades just like this because of the huge risk versus rewards and the potentially large payoffs. We'll get to that in just a second. So as you can see, our trading day starts. We go flat largely for the first 90 minutes of the session. Then we finally get some bullish pressure, flatten out for the next hour, and then we are off to the races. Finally, we get the big bullish price action. So now our job is to find a way into this trend. The intraday trend is up. We want to bid. We want to buy the market. Well, our 30-minute chart really isn't going to give us much of a way into that, at least not right away. I want to get as current as I can. I bring the periodicity of my charts down to a 5-minute chart. And as you can see right here, here's our breakout. There's our nice big bullish move. And look at right there. I mean, it's like it's Christmas, a nice red candle. That's our pullback. We want to bid right there, put our stop loss beneath that swing low. Now, the beauty of this is the risk versus reward. Now, it's going to take us just a second to line this up. We buy right there on the open of the next candle, and then you're going to bring this up. So our stop loss is just beneath our swing low here. A lot of professional traders will let these trades run until the end of the session, just betting that they've got perfect trade location and they're going to ride this trend really until that 2:30 p.m. Eastern. If that is the strategy here, you can see right there your risk versus rewards it's over 7, and you're looking to cash in almost $1,000, risking 1% of your $1,000 account. Essentially, you're doubling up. Now, a much more conservative approach would be to bring this down to, say, a 3-to-1 or something like this, and you'll have an opportunity potentially to make a very, very nice trade. So what you have, there's a lot of options for trend following. Just remember, I highly recommend at least a 2-to-1, maybe a 3 or 4-to-1 on intraday trend trading because trends are tough to get, but if you get them, they can be very lucrative. Now, this is a way that many price action traders trade crude oil each and every day, looking for those big profits on pullbacks using price action and price action alone. You know what time it is. It's quiz time. Answer the following question correctly, and you can win free access to the How to Trade trading room. Which is the largest shale oil play in the United States? Is it A, the Bakken, B, the Permian Basin, C, the Marcellus play, or D, Eagle Ford? Leave your answer below, and best of luck.
For the past decade, the crude oil markets have topped my trading list. Why? One word: action. Every day, oil gives me solid trade setups. If I had to trade only one market, it would be crude oil. Now, on a personal note, I spent time working in the Bakken oil fields in North Dakota in a setting a lot like this. Let me assure you that trading oil from your office, your laptop, or your phone is much more fun. Now, if you want to learn more about energy trading, check out a free trial at howtotrade.com. We have live streams, trade ideas, and educational content that can get you up and running in no time. You want to trade crude oil right now? Click the Switch Markets link below and get in the game. And as always, subscribe to our channel for more on all things trading. That's it from the Wild West. Trade the action well, and we'll see you in the markets.